All right, let's talk about something that's got a ton of myth and, let's be honest, a lot of marketing hype around it. Settling your tax debt with the IRS.
You've probably heard the stories, right? Maybe you've even seen those late-night TV ads promising you can settle a huge tax bill for just pennies on the dollar.
But here's the thing. Is that for real? Is it a myth? Or can it actually happen? Well, to get to the truth, we've got to do something a little different. We need to stop thinking like a taxpayer and start thinking like the IRS.
Okay, so let's get right into it. The big secret to what's called an offer in compromise, or OIC, it's not that the IRS is feeling generous. Not at all. It's about them being incredibly practical.
See, their internal policy is actually super simple. It's all about one thing: collecting what they can realistically get as fast as they can and for the least amount of cost. Think of it like a business decision. They'd rather resolve an account efficiently than spend years chasing a debt they know they might never fully get back anyway.
And this whole practical approach, it's not just a gut feeling. It's driven by a very specific formula. A formula the IRS uses to figure out the absolute rock-bottom number they're willing to accept.
And that formula has a name. It's called the Reasonable Collection Potential, or RCP. Honestly, understanding this one concept is the key that unlocks this entire process. If you take away just one thing today, make it this term: RCP. So what is it? It boils down to a pretty simple equation. It's what you have plus what you can earn, and that equals the IRS's magic number. It's really just a calculation of your total financial capacity.
It really just comes down to two big pieces. First, they calculate what you have. That's the net value of all your assets. Cash, cars, property, minus whatever you owe on them. And second, they project what you'll earn. This is all about your future disposable income over a certain period of time.
Now here's where it gets really interesting. These numbers, they aren't totally set in stone. This is where the strategy comes in, where real negotiation and, most importantly, proper documentation can make a huge difference. Now, there are actually a few different reasons the IRS might accept an offer. But for our purposes, we're focusing on the big one, the most common, math-based reason. It's called doubt as to collectibility. And that's just a fancy way of saying that your assets plus your future income, well, it adds up to less than the total tax you owe. And let's be super clear. This is not about hiding anything. It's all about accurately documenting your true financial picture. For example, a lot of high discretionary spending, that's going to hurt your case because it suggests you have more money to pay. But legitimate costs, things like documented medical bills or what it costs to care for a dependent, those can actually lower that future income calculation, and that in turn can lower the minimum offer the IRS will accept.
Okay, theory is great, but let's see how this math actually works in the real world. We'll run through a quick case study.
All right, so let's say we have a taxpayer who owes the IRS $120,000. Big number. First, the IRS does a deep dive into their finances. They figure out the net value of all their assets, cash on hand, what they could get for their car in a quick sale, any equity in their home, and after you subtract any loans, let's say it comes out to $10,000. Okay, that's the what you have part. Next up is what you'll earn. The IRS calculates their future disposable income is about $300 a month. Now, for a standard lump sum offer, they multiply that number by 12 months. So 300 times 12 gives you a future income potential of $3,600. So now we just do the math. You take the $10,000 in assets, add the $3,600 in future income, and there you have it. The IRS's minimum number, $13,600. That's the RCP. That's their number.
All right, so you've got your number, but submitting the offer isn't the end of it. It actually kicks off a really formal, very structured review process. This isn't like buying a lottery ticket. Think of it more like a full-on financial investigation.
And as you can see, your offer goes on a bit of a journey. It has to pass through multiple stages of review. First, there's just an initial check to make sure all the forms are right. Then an IRS specialist does their own deep dive to calculate that RCP. They make a recommendation, accept, reject, or maybe even a counteroffer. And finally, that recommendation gets reviewed and becomes the final decision. But through all of that, every single step is all about one thing: making sure your offer lines up with that core RCP number.
So we've gone through the myth, the math, and the process. What's the real bottom line here? What's the big takeaway?
It's this: a successful offer in compromise is not some magical tax break. It's about mastering the IRS's own math.
It's about proving, with solid, hard evidence, that your offer is the absolute most they can reasonably expect to ever get from you. You're not looking for a loophole. You're just presenting a documented, mathematical reality.